Hi, everyone, and welcome to this episode of my weekly trading plan. Of course, we have to talk about what everyone's talking about, and that is the potential for an upcoming recession and some expectations around what that might look like. And then we'll listen to a little bit of David Malpass, the World Bank Group President, on what he thinks about the upcoming potential for recession. Then, of course, we'll take a look at the charts, trying to make sense of the nonsense that has been going on recently. Of course, we'll go over some trade ideas as well as my current positions in my options account. If you like trading stocks and options and making money, definitely like and subscribe. I make videos like this as well as whole portfolio overviews every single week, so make sure you hit the bell so you don't miss out on any future content. Welcome to the Portfolio Bulletin. Let's get started. So what is the typical recession? At this point, it seems like it's going to become a self-fulfilling prophecy. Even if the economic factors somehow resolve in the future, enough people believe that there's going to be a recession that the markets are likely to go lower in the future. So they define what a recession is, which is a significant decline in economic activities, and they say this is ultimately inevitable for a normal economic cycle. Some of the percentages being thrown out right now are around 30 to 50% sometime in the next 18 months. But they do mention not everyone believes that a recession is going to happen, at least in the short term. And here you have Jerome Powell in his minutes saying that he's not convinced a recession is going to happen. They also mention UBS saying that they have a base case forecast for no recession, and the base case is always the most likely in their opinion, and they're saying for them that means no recession. They say the economy is slowing, and it will be uncomfortable for potentially 12 to 24 months, but they think we'll make it through without a full recession. Of course, there are many variables that could go wrong, and it could push us into a recession, but those things have not happened quite yet, and their base case is no recession. They think unemployment could potentially go to 4 to 4.5%, which would be a little bit higher than it is now, but not nearly as high as it was during the 2008 global financial crisis and some of the other recessions that we've seen in the past. Then they talk some of the results about what a recession looks like, whether it be a V-shape, a U-shape recovery, or a W or a K-shaped. I think everyone's pretty familiar with what a V and a U-shape recovery are, even a potentially W-shape recovery, but a K-shape means that some parts of the economy recover while others still tend to struggle. They take around 6 to 12 months to get all the way through, with the biggest recession since World War II spanning 18 months, and that was the 2008 financial crisis. Then they talk about some of the lengths in recessions, and you can see all the different lengths here as a function of highest unemployment rate. So we have the 1981 to 82 recession, which was 16 months, with an unemployment rate of around 10%, and then the financial crisis here with an unemployment of 9.5%, and that took 18 months. Most indicators say the market will fall another 5 to 10%, with national house prices declining about the same amount. I also want to mention another article saying the bad economic news that the Fed is looking for. And basically this is referencing that if the Fed starts to see bad economic data, they could potentially slow down their interest rate hikes and increase their bond buying to try to support the economy at least a little bit in the short term to help resolve some of the issues surrounding inflation as well as a slowing economy. I start off by saying the economy is bending but not breaking yet. And in my opinion, it seems like we're going to go lower. You can see the charts they have here for the Chicago Fed National Activity Index. This is economic activity, and you can see it's getting closer to that trend line and dipping below the zero mark, meaning that economic activity is slowing down. They have another similar metric here with the S&P US PMI composite. You can see output is continuing down towards that zero line and will potentially push into the negative. They also mentioned that the job market is continuing down. Of course, it was a little aggressive before, and it might be getting closer to what it should be, but it still is a slowdown, and the economy tends to overcorrect in both directions. So if it gets a little bit too soft, that potentially would be another trigger for a slowing economy or a recession. See posting rates continuing to trend down basically since the beginning of this year. Another pretty big metric is that mortgage rates have been skyrocketing compared to where they've been. They are now even higher than they were in 2018, kicking up way off the floors that we had here in 2020 and 21, with the 30-year fixed rate almost at a full 6%, similar to what it was during the 2008 financial crisis. Another big metric here is price drops for houses over a 4-week rolling period, and this is from Redfin. You can see the drop in prices has hit a pretty high percentage at 6.1%, higher than it's been in quite a long time, going all the way back to 2015. You could certainly argue that this is because people were putting their houses on the market at a really high rate, at a high price, and people are starting to realize that all the houses aren't going as fast as they thought anymore, and they aren't getting the prices that they wanted to get, and they've started to drop back into the more normalized range for their markets. But this is, again, another indicator that home sales are slowing, which is another indicator that the economy as a whole is slowing down. Of course, we have the national averages for gas, hitting over $6 in several states, as you can see over here. And to reinforce all of those points, let's hear from David Malpass, the World Bank Group president.
There are a lot of stressors on the global economic system right now. How do you describe where we are?
It's a sharp slowdown, including even China. So we've seen the world growth fall by half since January in terms of GDP growth, but there's also shortages, there's inflation, and the food shortages for the poorer countries are becoming a significant concern. They already are.
I mean, global inflation, it's not just the U.S., it's other wealthy countries around the world, but you're also describing a recipe for global instability.
It feeds in when there's not enough food that for weaker countries, poorer countries, that causes instability, and it's a big factor in the turnover of governments that's been occurring in quite a few of the countries.
Aside from the fact that this dude is basically asleep and talks extremely slow for some reason, what he's talking about is actually super important here. So the stability that we get out of having enough natural resources and basically fighting for that top line growth all the time definitely helps the wealthier countries. And if we see an economic slowdown along with a food shortage, that could definitely spell a deeper recession potential if we can't get these things fixed. And he goes on to talk about some of the issues that we're seeing around mulch and the ability to produce food in a short amount of time to meet demand.
So a State Department official said a few days ago, food crisis will be at least a 3-year problem. What time horizon do you put on the food crisis and the energy crisis?
I'll say one thing. It's possible to produce enough to soften that crisis. But at the rate that we're going right now, the fertilizer isn't being made. You know, fertilizer comes, a giant source of fertilizer is from natural gas through the ammonium channel into the most useful fertilizer. And it also is used to make the electricity that converts the minerals into fertilizer. And that's just not happening. So a lot of the world is shutting down for lack of fertilizer. And then those shortages of crops will last for multiple years.
Again, talking about the necessity for food and some of the unforeseen or potentially foreseen, if you're paying attention to the right news cycles, of COVID. So when we shut down the global economy, we thought we could pretty much turn that thing right back on once the time came. And it turns out we can't quite do that. So we're still seeing shortages, specifically with food, going down to the root cause of fertilizer across the globe, and the difficulties in producing effective fertilizer and then getting that fertilizer to the place where we need to grow food, and then actually growing the food off of that fertilizer takes time, and we're still not to the place where we need to be to meet the global demand. He then finishes off this interview by not giving a lot of specifics, but saying that a downside case for a recession is certainly possible, but he doesn't see it in their base case for the United States. Moving over here to the S&P 500 charts, based off all the things that we've said already, with a potential recession coming, we should not expect this massive run we've had over the last week to hold. You can see we came in and bounced off of this pretty centralized long-term trend channel we had, and came into this zone of resistance that we had going back quite a ways, all the way to September of 21, a couple of interactions here through February, again through May, and then once more here in June. So there's certainly potential we could get a push through maybe into this mid-range, but this would be strong resistance in my opinion, at which point I would expect another down movement. You could kind of argue that this is a bottom and a lower double bottom, but in my opinion this is a continuation of a trend and we would need to see a second bottom here form before I would potentially expect some longer-term upside. So we might see some short-term upside in the next day or two, Monday, Tuesday, but then I expect this to fail going forward. And moving over here to the NASDAQ, the main reason that I expect this to go maybe a little bit higher on Monday, Tuesday is because we haven't quite hit that resistance on growth. So growth looks a little bit stronger with this longer bull move. And you can see we're not quite at resistance, maybe closer to that $300 level, which is really maybe 1 or 2% higher than we are right now. And then I expect a full rejection to the lows or back into this resistance levels down at 280. So few dollars upside with a nice little down move following that going into the next week or two. Moving over here to the VIX, I definitely want to start including this more consistently, as this was a very good indicator of what was coming in the upcoming week. You can see we're in that resistance point on the daily chart going into the week. And then we had that nice move down, which was that up move that we saw in the NASDAQ and the S&Ps. Now we're right at that support level, potentially a breakthrough down to this lower support at the 144-day moving average. Or if we go a little bit lower and we get that last little push up higher, we would find support around that 22, 23 level, which we've seen consistently interacted with here in January, April, as well as in November, which was the all-time highs here when we started that channel. So potential for a little bit of down move or another breakthrough. If we get that breakthrough, I would be looking for a buying opportunity down here. Again, I will continue to include this in my weekly updates. Moving over here to a stock that formed a pretty solid double bottom, or you could argue a higher low, here is Salesforce. So we have a nice bottom here in May, a higher low in June, and we're now pushing up higher. You could see we have that potential for a little bit more upside before we hit strong resistance, similar to the NASDAQ. And if we do get a nice little rejection, support here at the middle of that W, and then a push through that upper level of resistance, there's potential that we could go significantly higher. So keep Salesforce on your radar and look for that push up to resistance here in the short term, potentially a pullback and a push higher. Another stock that I like quite a bit is AMD. Of course, this doesn't look nearly as strong as some of the others, but if you zoom out quite a bit here, you can see this zone of support that we're in right here is a very, very long-term trend, going all the way back to the 2000s and even further on the longer-term charts. And we had what looks like a pretty decent double bottom here on the 4-hour chart here on 17 June and then again here on 23 June. So pretty close together, nice little W looking double bottom and a strong move up over the last 3 days with the potential for another $3 to $6 of upside potential up to that 144 moving average, which is currently at $94. The stock is currently at 87. Moving on to Lululemon, I kind of have a lot of stocks on my radar this week, but we did see a pretty solid turnaround and some potential for bullish price action in the future. So Lululemon here, you can see big bottom on May 24th and 25th, higher low here in the previous week. And you can see we're at that resistance from February and March. If we get a nice little breakthrough, we can see a nice W forming, with the potential for resistance in that 322 range, which is around 10% upside from where we are right now. Moving over here to XOP, this is the oil and gas product ETF. You can see we had a huge down move on the daily chart, coming into some support at that 120 range. I wouldn't be buying in here quite yet. This still looks pretty weak. And we have some longer term support, maybe closer to that $100 range. If this extends out, you can see right around $100, and usually you get a stronger pullback off of this really strong rally, but it's hard to tell if we do see another surge up in oil prices. This certainly looks like a nice buying opportunity, and even if you choose to sell some weekly options in here, you could probably get a decent price to buy the stock closer to 110, which certainly looks like a better buying opportunity than here, and there's potentially some support here in these February highs that we had, as well as the longer term high in November. So keep oil and gas on your radar, but right now this is a falling knife. Moving over here to some trade ideas, looking at CRM first, some better volume than some of the other stocks that we've looked at, with a little bit over 1,000 puts being traded at $180. So it looks like decent support in that price range. And then on the call side, you have around 1,600 calls being exchanged at the 185 price range. So kind of locked in between 180 and 185 for right now. And you can see the estimated move over the next week is somewhere around that 177.50 level. So it makes sense if you sell this 180 put for $1.80, that puts you pretty close to that expected move in the week. If we get a dip into that 180 level, it might be a good idea to sell these 180s for a little bit higher price. If you do sell the at the monies, you can get it a little bit over 2% for a stock that seems to be outperforming the market and looks definitely more bullish in the short term than the major indices. And then next up, we have Lululemon. Less volume definitely than CRM, so definitely watch those spreads when you're trading. But around that 280 level, we have some decent support, and I think the stock is pretty undervalued at 280, which is $12 lower than where we're trading right now. If we could see a move down first before selling puts, that would be ideal. But even if you don't, you can sell the 290s for close to $6 if you get a good price. But again, watch out for those spreads. And then finishing up here with the NASDAQ, you can see the expected move on Monday is close to that 290 level. And I do have 2 puts laid on already, as I do expect a little bit of an up move on Monday, or maybe a flat day. The stock closed at 294.50, so a little bit higher than where we are right now. But I certainly wouldn't be looking to sell too many puts on Monday, as I do expect the NASDAQ to dip later into the week. If we look further out to the 5-day puts, closing on July 1st, you can see that expected move is pretty low, down here all the way to 285, which is what I was saying before. So this potential for downside is definitely pretty high. You can see the biggest volume is right here at 284, with 18,000 puts being exchanged at that price. You can see a pretty big number here, 10,000 at 290, but that 284 put has the biggest volume. Moving over here to my progress, you can see we definitely bumped up a little bit of money this week. Currently down only 16,000 on the year, which is pretty good for me. And I have 2 puts going into Monday, as I expect the markets to rally just a little bit. And then over the course of the week, I will be averaging down as the market moves down in my expectation. Let me know down in the comments section what you think of my portfolio update. Are we going into a deeper recession, and are the markets going to go lower? Or is this a bottom and we just don't quite know it yet? If there's any stocks you want me to address, definitely throw those down in the comments as well. Let me know if you make any good trades off of my thoughts. Definitely like and subscribe if you got any value out of this video. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your trading and have a great day.